If you've got student loans scattered across different servicers, different due dates, different interest rates, consolidation sounds like the dream. One loan. One payment, done. But here's what almost nobody is telling you. Because of a new federal law, the One Big Beautiful Bill Act, the rules apply from July 1st, 2026. And if you consolidate your federal loans at the wrong time, you can now get permanently locked out of the cheapest repayment plans in the system. Plans like income-based repayment, pay, and ICR that let some borrowers pay as little as $0 a month. Consolidate one day too late, and that option can be gone for good. So before you touch that application, let me show you how to consolidate the right way, the handful of people who actually should, and the trap that's already catching thousands of borrowers. So let's start with what consolidation actually is, in plain English. When you consolidate your federal student loans, the government combines all of them into a single new loan. It's called a direct consolidation loan. Instead of juggling 4 or 5 different balances with different due dates and different servicers, you get one loan, one monthly payment, one place to manage it all. That's the appeal. Simplicity. Now, quick but important note before we go further. This is educational, not financial advice, so always check your own situation at studentaid.gov before you make any moves. Here's the part that trips people up, and it's the first expensive mistake. Consolidation is not the same thing as refinancing. People use these words like they mean the same thing. They don't. Consolidation is a government program. Your loans stay federal, and you keep your federal protections. Refinancing is completely different. That's when a private company pays off your federal loans and replaces them with a brand new private loan. And the moment you do that, those federal protections are gone. Permanently. No income-driven plans. No federal forgiveness. No going back. So keep that difference in your head, because it matters more than almost anything else we're going to talk about. Now let's talk about the biggest myth in the entire student loan world. The idea that consolidating your loans will lower your interest rate. It won't. And anyone telling you otherwise is either confused or they're trying to sell you something. Here's how it actually works. When the government consolidates your loans, your new interest rate isn't lower. It's the weighted average of all your existing rates, rounded up to the nearest 1/8 of 1%. Let me say that again, because it's the whole point. They take the average of what you're already paying, and then they round it up. So at best, your rate stays about the same. It does not go down. What you're actually getting from consolidation is simplicity. One payment instead of 5. That's the trade. You're paying for convenience, not for savings. And that's fine if simplicity is what you need. But if someone is pitching consolidation to you as a way to slash your interest rate and save thousands, stop right there. That's not how this works. And the fact that they are saying it should make you question what else they are getting wrong. Okay. This is the part nobody warns you about, and it's the most important part of this whole video. The hidden costs of consolidation. There are 3 of them, and any single one can cost you real money. Hidden cost number 1. Interest capitalization. Here's what that means. If you have any unpaid interest sitting on your loans, the moment you consolidate, that interest gets added on top of your principal. Your principal is the original amount you borrowed. So now you're not just paying interest on what you borrowed. You're paying interest on your old interest too. Your balance quietly gets bigger, and most people never even notice. Hidden cost number 2. A longer repayment term. Consolidation can stretch your loan out from 10 years to 20 years, sometimes even 30. And yes, that makes your monthly payment smaller, which feels great. But stretching the loan out means you pay for way more years, and you end up paying a lot more in total interest over the life of the loan. Lower monthly payment. Higher total cost. Hidden cost number 3, and this is the big one. Consolidation can erase your progress toward loan forgiveness. If you've been making payments that count toward an income-driven forgiveness plan, Consolidating can reset that clock back to zero. Years of payments gone. And here's the part that should make you stop and think. Consolidation is permanent. Once you combine those loans, you cannot undo it. There's no reset button. So if any of these three things applies to you, you need to know it before you click that button, not after. Now here's the part I promised you at the very beginning. The part that almost nobody is talking about yet. And if you take one thing away from this entire video, make it this. Because of that new federal law, the One Big Beautiful Bill Act, everything changed on July 1st, 2026. And the timing of when you consolidate now matters more than it ever has before. Here's the rule. If your consolidation loan is issued on or after July 1st, 2026, then that loan and all of your other federal direct loans can only be repaid using two new plans. The Repayment Assistance Plan, which you'll hear called RAP, and the new Tiered Standard Plan. That sounds harmless until you realize what you're giving up. By consolidating after that date, you lose access to the older income-driven repayment plans. Plans like income-based repayment, also called IBR, Plus Pay, and ICR. These are the plans that let lower-income borrowers pay as little as $0 a month, based on what they actually earn. Consolidate at the wrong time, and that safety net can disappear. And if you're a parent, listen closely, because this one is brutal. If your consolidation includes a Parent Plus loan, and it's issued after July 1st, 2026, that loan loses access to every single income-driven repayment option. All of them. This is exactly what they don't tell you. And it's exactly why timing is everything. Now, I want to be fair here, because consolidation isn't always a trap. For some people, it's genuinely the right move. The key is knowing which situation you're actually in. So here's when consolidating really does make sense. First, if you have older types of federal loans, like FFEL loans or Perkins loans, those don't always qualify for the best programs on their own. Consolidating them into a direct loan can actually unlock access to public service loan forgiveness and to income-driven repayment plans you couldn't use before. In that case, consolidation opens doors instead of closing them. Second, if your federal loans have fallen into default, consolidation can be a way to pull them back out of default and stop the collection calls, the wage garnishment, all of it. For someone in that situation, it can be a genuine lifeline. So think of consolidation like a scalpel, not a sledgehammer. In the right hands for the right problem, it's a powerful tool. The mistake is using it blindly, without knowing whether it actually fits your situation. Okay, so let's say you've thought it through, and consolidation is the right move for you. Here's exactly how to do it the right way without getting ripped off. You do it yourself, for free, at one official website. studentaid.gov. That's the U.S. Department of Education's official site. You log in, you fill out the direct consolidation loan application right there online, and the whole thing takes about 30 minutes. The government processes everything electronically. There is no fee, none. And that brings me to the warning you need to hear. If you ever see a company offering to consolidate your federal loans for a fee, stop. Those are not the government. A lot of them are flat-out scams, charging you hundreds or even thousands of dollars for something you can do yourself, for free in half an hour. So say it with me. You never, ever pay anyone to consolidate your federal student loans. If there's a fee, it's a scam. Full stop. So let's bring it all together. Consolidation is a tool. It is not a shortcut, and it is not a trick to lower your interest rate. For the right person, in the right situation, it can simplify your life or even pull you out of default. But for the wrong person, at the wrong time, it can cost you thousands, reset your forgiveness progress, and lock you out of the plans that protect you. Especially now, with the new rules that took effect on July 1st, 2026. The difference between those two outcomes is simply knowing what you're doing before you click that button. And now you do. So here's your one takeaway. Never consolidate in a hurry, and never pay anyone to do it for you. If this helped you see behind the curtain, do me one quick favor and subscribe. Here at the Money Curtain, that's exactly what we do. We pull back the curtain on the money decisions that actually affect your life. Thanks for watching, and I'll see you in the next one.